Looking to invest in a fantastic business? Want a 3% plus yield and 20% plus dividend growth? Interested in getting a great deal on a high quality stock after it's dropped by nearly 20%? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a leading investment bank and a leading wealth manager. Investment banking is very lucrative. Advisement, IPOs, M&A, etc. Wealth management is also very lucrative. Well, this business does both at world-class scale, and that leads to lots of growing profits and lots of growing dividends. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Morgan Stanley, which appear to be trading at a significant discount today. Morgan Stanley, stock ticker MS, is a multinational investment bank and financial services company. Founded in 1924, Morgan Stanley is now a $154 billion by market cap investment banking powerhouse that employs 75,000 people. The company has three operating segments: Institutional Securities Group, 50% of fiscal year 2021 revenue, Global Wealth Management Group, 41%, and Investment Management Group, 9%. Morgan Stanley has become one of the largest diversified capital markets banking institutions in the world. Under the leadership of CEO James Gorman, Morgan Stanley has made impressive progress over the last decade and built out a powerful one-two punch. On one hand, they're one of the leaders in the investment banking space. This includes capital raising activities, financial advisory services, and corporate lending. Morgan Stanley is often involved in major IPOs, mergers, and acquisitions. On the other hand, they're a significant player in the wealth management space. Recent acquisitions of E-Trade and Eaton Vance have scaled this side of the company out even further and increased the fees it can collect. With global asset values rising over the long term, Morgan Stanley should see continued growth here as a natural course of doing business. For perspective on their scale, Morgan Stanley has $4.9 trillion in client assets under management. That makes them one of the largest asset managers in the world. In my view, a bet on Morgan Stanley is basically a bet on US-centric capitalism. That's been a very correct and profitable bet for more than a century, and I suspect it'll be a very correct and profitable bet over the next century. This means higher revenue, more profit, and a bigger dividend over the years to come for the company and its shareholders. Already, Morgan Stanley has increased its dividend for 8 consecutive years. While that track record isn't as lengthy as some other vaunted financial institutions, the 5-year dividend growth rate of 24.6% shows eagerness to make up for lost time. In fact, the company's most recent dividend increase was a jaw-dropping 100%. The huge dividend increase combined with some recent weakness in the share price has caused the yield to rise to 3.2%. That is more than twice as high as the broader market's yield. It's also a full 100 basis points higher than its own 5-year average. And even after all of that dividend growth, the payout ratio remains a low 34.9%. I like dividend growth stocks in what I call the sweet spot. That's a yield of between 2.5% and 3.5%, paired with a high single-digit or better dividend growth rate. The yield is on the higher end of that range, while the dividend growth rate is much higher than what I'm typically looking for. It's about as sweet as it gets here. Looking at business growth, Morgan Stanley increased its revenue from $26.1 billion in fiscal year 2012 to $59.8 billion in fiscal year 2021. That's a compound annual growth rate of 9.7%. Really strong top-line growth here. I usually look for a mid-single-digit top-line growth rate from a mature company like this, but Morgan Stanley easily exceeded my expectations. Because of no positive GAAP earnings per share number for fiscal year 2012, I'll advance the earnings per share comparison by 1 year to fiscal year 2013. Earnings per share grew from $1.36 to $8.03 over this 9-year period, which is a compound annual growth rate of 21.8%. It's now easy to see the direct link from earnings per share growth to dividend growth here. Both have been growing at 20% plus annually. Buybacks have helped to power some of the excess bottom line growth, but a material expansion in net margin has been the real driver of this. Looking forward, CFRA believes that Morgan Stanley will compound its earnings per share at an annual rate of 5% over the next 3 years. This would be a steep drop in growth compared to what Morgan Stanley has produced over the last decade. This could prove to be a bit too conservative, but I think it's appropriate to expect some slowdown relative to the extraordinary results that we've seen lately. There are 2 issues that will likely act as near-term headwinds for Morgan Stanley. First, there's the high likelihood of lower activity around investment banking. Public listings, corporate activity, and general enthusiasm for the U.S. capital markets went into overdrive over the last 2 years. The flooding of liquidity through fiscal and monetary policies propelled exuberance. Second, lower asset values from current volatility, geopolitical events, and any possible recession would reduce assets under management and the fees generated. However, the idea of investing in Morgan Stanley, like all ideas I present and personally put capital to work with, is a long-term one. I'm quite sure that this company, like most other companies, will see its growth come down quite a bit over the near term, but the long-term story doesn't look broken to me. It's simply a story that won't be quite as exciting over the next year or two. Keep in mind, the stock's price has recently come down dramatically, contracting the valuation. The market has already factored in diminished growth. Overall, I think Morgan Stanley is easily positioned to hand out high single-digit dividend raises for the foreseeable future, even with 5% earnings per share growth, by virtue of the low payout ratio. Stacking that kind of dividend growth on top of a starting yield of over 3% presents a compelling combination. Moving over to the balance sheet, the company has a solid financial position. Total assets of $1.2 trillion match up against $1.1 trillion in total liabilities. Investment-grade credit ratings for the parent company's long-term debt are as follows: BBB+, Standard & Poor's, A Fitch, A1 Moody's. Profitability is robust. Over the last 5 years, the firm has averaged annual net margin of 21.1% and an annual return on equity of 11.5%. Regarding the material expansion in net margin that I touched on earlier, the company was printing single-digit annual net margin 10 years ago. It's hard to overstate the improvement here. There's very little to dislike about Morgan Stanley. It's a world-class institution that has melded together 2 fantastic business models in investment banking and wealth management. And with global scale, a network effect, switching costs, brand power, and industry know-how, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. The financial industry is highly competitive, although Morgan Stanley's scale limits this somewhat. On the other hand, regulation is a major ongoing issue that only becomes more problematic at scale. The company is heavily reliant on corporate action. Any economic slowdown would likely result in a reduction of this kind of activity. There is substantial exposure to global capital markets here. Negative world events, including geopolitical flare-ups and/or recessions, can reduce asset values and the fees that Morgan Stanley can collect. Executional risks are present. Recent acquisitions of Eaton Vance and E-Trade must be properly integrated and utilized. And the last decade's expansion in margin is highly unlikely to repeat itself. It's good to be mindful of the risks, but I still think Morgan Stanley's overall caliber outweighs them. And with the stock down 20% from its 52-week high, the valuation has become attractive. The stock is trading hands for a price-earnings ratio of 10.9. That's about half that of the broader market's earnings multiple. It's also lower than the stock's own 5-year average PE ratio of 11.6. And the yield, as noted earlier, is much higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. That dividend growth rate is not as aggressive as I can go, and when you look at what Morgan Stanley has demonstrated in terms of EPS and dividend growth over the last decade, this might look conservative, but I think some caution is warranted. Morgan Stanley has had an amazing decade, highly impressive across the board, but the road ahead becomes more difficult with less liquidity, hot geopolitics, and rising recession risks all looming. Still, even with CFRE's EPS growth slowdown factored in, the overall quality of the business, along with the low payout ratio, gives the company leeway on future dividend raises. I see this as a fair assessment of their long-term dividend growth potential. The dividend discount model analysis gives me a fair value of $99.87. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Morgan Stanley as a 3-star stock with a fair value estimate of $89. CFRA rates Morgan Stanley as a 4-star buy with a 12-month target price of $115. I came out in the middle this time around, averaging the three numbers out, gives us a final valuation of $101.29, which would indicate the stock is possibly 16% undervalued. Here's the bottom line, guys. Morgan Stanley is a high-quality company that has put two excellent business models under one roof. It's now a world-class financial institution with few rivals, which bodes extremely well for their future prospects. With a 3% plus yield, double-digit dividend growth, a low payout ratio, 8 consecutive years of dividend increases, and the potential that shares are 16% undervalued, long-term dividend growth investors would be wise to consider buying the stock on the big dip. And now for a special news announcement. It was just announced that the CEO of Linda PLC, stock ticker LIN, Sanjeev Lamba, personally bought $1 million worth of company stock. And this comes after the company itself announced a $10 billion buyback program. The CEO thinks it's worth buying. The company thinks it's worth buying. And I'm inclined to agree. The industrial gases space is an incredibly attractive space to be in for the long term. If Linda wasn't already on your radar, it should be now. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.